Hello, today we're going to be looking at ticker symbol MSFT Microsoft Corporation. They are currently trading at $337.22 at the time of this video. They have a dividend rate per year of about $2.72, which brings its yield to around 0.80%. They have a market cap of $54 trillion. Currently, the only company to reach a $3 trillion valuation is Apple, so Microsoft would like to join them soon. We're here to determine their valuation, intrinsic value, using several different methods to see when we would like a good price to get into Microsoft Corporation. Currently, they are up 40.75% year to date since January. As you can see, they were down here at about $229, and then up here. I'm pretty sure they went lower this year, or maybe it wasn't this year, it was in November or December of last year. Because see, their low point was $213 within the last 52 weeks. But we're going to head over here to Macro Trends. It's a great website, a lot of free information. As you can see here, we're on other ratios at the moment because we're going to look at their free cash flow. As you can see, it's been increasing over the last several years. But the free cash flow for the quarter ending March 31st, 2023 was 39,648 year over year. So we'll have to take that in consideration typically when you're doing an evaluation, but this isn't too important right now because we're going to go off their average free cash flow. As you can see, since 2013 they steadily have been going up. See, and then they right here 23, but look, 24, 31, 32, 38, 45, 56, $65,144 at the end of 2022. And then as you can come over to their revenue and profit, and they've been steadily increasing also. Even in their last quarter, earning $52.857 billion, which is a 7% increase year over year. So they're still growing. As you can see, 13%, 17%, 17% year over year. That includes COVID, and a lot of businesses were seeing a lot of cash flow during COVID, but Microsoft is just they're a revenue giant. I mean, as you can see, 2010, 62 million, and then in 2022 we have 198. Like, that's incredible. But the Microtrends has a lot of great information. Their shares outstanding, as you can see, 7.683 billion, and then now they're down to 7.464 billion, which means that Microsoft is currently buying shares back, which will be good for investors overall. Their current EPS 9.65 for 2021, trailing last 12 months as of March 31st is 9.24, which is a decline year over year. But Microsoft is also buying a lot of businesses. They're currently trying to buy Activision, which would be a huge deal for them. Activision, if you're not aware, they're a huge gaming company, and they make Call of Duty, and Call of Duty is a huge money maker for them. Their net income, they're increasing year over year. You can scroll down here and you can see how under many years. Another thing is for Microtrends is that like if you were to come over to financials, you can see their whole annual, like all kinds of information. A lot of people do like to look at stuff like this, because if you go into like balance sheet, it has like their current assets, their total assets, their current liabilities, equity, stuff like that. Then their cash flow statements. You really have to learn your financial statements to get into stuff like that. We're not here to do that on this video. But you can see that gross margin over here on the key financials, current ratio, long-term debt capital, stuff like that. Free cash flow per share. You can see it's steadily going up over the years. But let's get into the evaluation, the intrinsic value of Microsoft Corporation. I have a few different methods here. See, I have two discounted cash flow calculators because, for some businesses, you don't need to be so discounted. We have the Benjamin Graham valuation method, the new one and the old one. And then we just have a dividend dividend discount model because people like to evaluate corporations differently. So currently, I'm not taking into the average free cash flow that I would usually do for businesses because Microsoft continues to grow, and we do want a little more premium for a great business like Microsoft is going to grow into the future. Um, I'm using a 12.5% growth rate, but there are people that think it's going to grow 16%, analysts and then other people who evaluate Microsoft. I'm using 12.5. I've also looked into 10%, but as you can see, with their revenue, if you want to go off revenue, if you want to go off free cash flow, if you want to go off net income, there's some people that use net income. There's all different ways to get your growth rate. So as you can see here, we have a 10% discount rate, perpetuity 2%, outstanding shares for Microsoft 7464. You can get that over here for free. And revenue and profit on micro trends, shares outstanding. So after entering this information, we get a discounted cash flow, no discount, $238.30. Bull case 214, bear case 190, base case 190, and then share bear case 160, and then recession $132.15. But I doubt it would get that low. But if we go over here to our discounted cash flow 2 that I like to use for a business like Microsoft, once again, we're just using their last cash flow from the end of 2022 with a 12.5% growth rate, 2% perpetuity discount rate, 10% to discount this cash flow. And then we have shares outstanding. We're going to come to a discounted cash price per share of $350.66. Then we're going to apply discount rates on top of that. So 10%, $317, 15%, $299.76, and 20%, $282.13. We're going to come over here to the Benjamin Graham updated formula, which just means that instead of using 8, we're using 7, and then the aggressive one is 7.5. Here's the formula, because the growth rates, G, they change depending upon the method. 2 is the old method, 1 is the new method. So we're going to have an EPS of 9.26, growth rate of 12.5%, corporate bond rate 4, PE of a no-growth company at 7. We're going to have an intrinsic value of $198.63, and the old formula, $325.95. And you can see the current trading price of $341.27 when I did this formula, and the difference is 4.59%. And then we'll come over here to the dividend discount model. I'm using a 7% growth rate for Microsoft and a discount rate of 8% with the current price when I did this, $341.27, which brings our dividend discount model price per share to $291.04, which is a 15.89% difference. And we go back to this one here if you wanted to use like a growth rate of 16%. Let's see. So we're going to do 0.16. And then it's going to change their values. I mean, $482.21, which is what some analysts say it's going to go up to. I personally don't think I would want to be investing at those prices. So if I'm going to do that, I'm going to go to this one for 16%, and you're going to see what we're going to get here. So see a discounted cash flow, $307.54, bull case $276.78. So we're just going to come over here to price to earnings ratio, and as you can see, I put the earnings per share at 9.64, so a PE ratio of 25, which would bring it to $241 at a PE ratio of 25. And a good company, you want between 20 to 25 for a PE ratio, but a company like Microsoft, I would be comfortable paying 25 to 30. So if we were to type in 30 here, so you would get a price per share of $289.20. And if you come over here to my discounted cash flow, as you can see, it's very close to these prices. This one, let's go back to my growth rate here that I would prefer over the 10-year span, 12.5, which seems pretty realistic in my eyes. Oops, I'm sorry. You got to do 0.125. So $352.66, $317.39, $299.76, and a 20% discount rate, $282.13. Benjamin Graham and the dividend discount model. So if you were a dividend growth investor, there are reasons to believe that it could grow at 8%. So you would have to move the discount rate to 9% because it can't be. So it'd still be $293.76. If you wanted to have a discount rate of 10 and think they're still going to grow at that 9 to 10% ratio, $296.48. So there's ways to do the dividend discount model that change. But if you want to look here at the PE ratio, there's been times where Microsoft hit 50, and if you think Microsoft can hit 50 again, well, boom, $482. So it still has room to grow. Microsoft is a great company. If you come over here to macro trends though, and the assets and liabilities, they do have total assets an increase year over year, but total liabilities, it's increasing, but they have great management, and there's no reason to worry. But yeah, so that's my valuation here of Microsoft MSFT. I would like to stick to the 12.5% growth rate, and I would have comfortable, after looking at all this data that we've looked at, I would say a comfortable buy price would be about the 240 to 260 range. And if I was just focusing purely on dividends, anything around 300 or lower would be a great time to buy, preferably 280. So 280 if I was doing the dividend discount model, or lower. If I was really focused on the Benjamin Graham, I would just stick hard to the aggressive value because you're going to want to pay premium. Like the $238, that's a great buy price no matter what. Like, oh, these other ones here, they're just discounted more. $214, that would be an amazing price. So I'd stick to this one. And, let's just say over a 10-year period, because that's a long time to project. We'll go to the 10% growth rate, see, discount 280 for the regular, and then discounted $251. So it's a great company, and I think I did buy a majority of my shares at an average price about $265 because I bought into the 280 range, but I picked up most of my shares around 220 to 240. I just didn't have a lot of capital at the time, so I wasn't able to increase my position as it kept going down. But that's investing. So yeah, thank you.